Welcome back, YouTube. Welcome to Black Wall Street Trading, LLC. And today we are presenting intentionally getting a sign using the secure put strategy. So before we get started with the video, if you would like, subscribe to the channel. I really do appreciate those who have subscribed. Thank you so much. And now let's get into the video. So intentionally getting a sign. This weekend, I was assigned expiration on the 18th. I was assigned. Here's a message from Robinhood in my Robinhood account. You were assigned on your PEI put option. You were assigned 100 shares of PEI. You were debited an amount of $300. So let me explain that. So when I first initially put on this trade, which was a secured put, I put up $300 right here in collateral, because I chose a $3 strike price. Now, I specifically chose that strike price because that strike price was going to give me the best option of getting a sign on this particular stock. Now, the reason whenever you execute a secure put, you want to make sure that this is a stock you want to own. I want to own PEI. PEI, which stands for Pennsylvania Reinvestment. It's a Pennsylvania REIT, so it's a reinvestment trust. It's a real estate investment trust, not reinvestment, a real estate investment trust. It has been predicted to move toward $7 within a year, $7.49 per share, and within a year's time frame. The P&E was a positive P&E, so they have the ability to earn money. And this stock has been tracked over the course of a year by other analysts, but I did my own individual research. So this is why you have to be able to do fundamental analysis. And aside from that, it does pay out a dividend of 0.71 per quarter. So it is a good, solid stock. It has a strong market cap, over 2 billion, great volume. So I'm going to hold on to this particular one. So my mission on getting a sign was accomplished. So let me show you how I did it. All right. So why would I want to get a sign? So the whole goal, when you have a stock that you want to own, the whole goal behind that is to obtain the stock as low as you possibly can. When I first put the trade on, the stock was trading at $3 and $3.53 a share. So that would have been me selling it outright at buying it outright at $353. Now, that's the first goal, to obtain the stock as low as possible for a long term. And like I just said, I want to have this stock for a long term in my portfolio. So the next reason you want to get a sign is to sell covered call strategy against it. Remember, if you are following me and you are learning my methodology, then you know that we sell options. We don't buy options. We don't buy puts. We don't buy calls, especially naked puts or naked calls, because there are no downside protections. And I'm just not comfortable buying puts and calls. And you will not always be able to sell out of that position if the market goes against you. And without any downside protection, you're putting your entire account at risk, because you don't know when a stock will go to zero. So don't think you do. Also, to receive dividends. So, and that's going to be a part of your long-term strategy if you want to look at this for the long term. It is possible for you to have improve your monthly income, if that's what you're trying to accomplish, by trading stocks like REITs and EFTs that typically pay a dividend, and some pay dividends every month. All right. So how do we do it? Well, if you remember back in my previous videos, if not, go ahead, subscribe to the channel and look back at those videos. We talked about the necessity for you to learn how to do technical analysis. Okay, so here's just a very brief class. This video is not about learning technical analysis, but here's one way to understand when a bearish position is about to occur. Okay, so I trade the Heikin Ashi candles which I will show you in the next picture what I'm looking for. But for a typical, for a normal setup where you're having solid candles and you're using the candlestick chart, if you look right here, this is what you call an engulfing candle. This red one, this red right here is an engulfing candle. So the last green candle, which is a short position, the red candle is engulfing it. It is much larger than the previous green. That's an indicator that the position is about to change and go down. Also, there are gojis called hammer gojis, or that's what I call them. They look like small hammers where there was not a lot of volume being traded at that position. And then that is a key. That's another indicator that if it's a green hammer, that is probably going to go for a downturn, or it could, or a reversal in trend. So if it was seeming like it was about to trend up and go to consolidate, and then a short goji comes in, that means there's not a lot of buying pressure. Then now you start to see seeing the bears come into play and start selling off, and the bulls have backed out of the market at that particular position, and then you get a stream of candles which start to look like this in the picture. As you can see here in the picture, this was showing a downtrend. So right here at the very top, right there, that's my goji. Here's my other goji that I was looking at. There was not a lot. That let me know that there was an indication that it might take a turn. This goji gave me a confirmation, and then here we go, boom. And then there was a decrease in the buying pressure, and what confirmed it was in the Hakanashi, there are no shadows there. If you look this entire, there are no shadows on the top of the bars. So after this last goji here, the next one there was no shadow, and that was, I knew for a fact that it was going to head into a downtrend. So by knowing that, the indicator back here, I was able to put the trade on for the secured put, because this is a 4-hour chart, previous days, and I knew that it was going to start a downtrend. So I went ahead and did the secured put and just waited until the 18th, knowing that it was not going to come back up above my strike. I knew it was going to fall below the strike and not have enough time to come back up before it closed, and it closed at $2.55 on the day of the 18th. So I was able to get a sign on that. So what are you going to do? Well, you're not going to buy a call. We don't buy. We actually sell. So the picture here is not this is not actually correct. So we're going to sell a covered call. And when you sell the covered call, all right, I would choose the strike price of $4 and collect just a little bit of premium. But when I actually put the covered call on, I collected $43 in premium, because like I said, that's not the correct part of the chain. All right, so this is the correct part of the chain right here. So the $4 strike, collecting $43 in premium. That's now that you've been assigned the stock. So now that you've been assigned the stock, you can actually sell a call against the stock. So what you're going to do is you're going to put the 100 shares up, and you're going to go far out. If you look right here, I'm going all the way out about 6 months to January the 21st, 2022. And I'll be looking to come out of the position prior to that, but we'll get into that later on in the video. So, but I will choose the $4 strike price, because I don't believe that the stock is going to rise up above $4 before expiration. I don't see it. Now, I'm not going to wait until expiration. I will probably close this position in 3 months or 4 months, about 50% of the way. I'll pay to close the position. And by that time, theta decay would be moving more toward my favor. So I could sell another cover call against it because I don't want the stocks called away from me. So once you've acquired the stocks, if you choose this strike price, just like you were assigned when it fell below, if the current trading price, which is this price right here, if it rises above the strike price of $4, chances are that that stock will get called away from you. Now, typically that does not happen until the day of expiration, typically around 1 hour before expiration. But remember, the person who holds the contract that you sold, they have the right and not the obligation to exercise that contract and buy those shares at your predetermined strike price of $4 per share on or before expiration. Okay, so when you're choosing these strike prices, don't just choose a price based on the highest premium. If we were doing that, we would choose $1 strike price, and that would just, what's the point in doing that? Like, you're going to get exercised on that pretty fast. So the math behind the madness. So the current price is trading at $2.55, as we saw on the previous technical analysis screen. You paid $3 per share. Where did the $3 come from? Originally, when I sold the secure put, I chose a strike price of $3. $3 times 100. Remember, we have to always use our 100 multiplier because all options have 100 shares of stock within the contract. So that equals $300. And the previous high was $3.45. So you saved yourself $45. So rather than purchasing the stock at $3.45 per share, and you saved $45 by getting assigned on the stock. So you're going to sell the $4 strike at 43 cents times 100 equals $43. You're going to collect that premium. You're going to put that back into your pocket. Remember, back here, you sold a put and you collected a premium of $35. Okay. So you've already collected $78 worth of income from these transactions. So your cost basis is not $255, it's not $300. Your cost basis is $177. So let's say you sold your covered call and you don't want to hold on to the stock, and it goes back up to $3.45. You do have the right to sell those stocks in the market, close your position, sell those stocks in the market, and collect another profit of $168. All right. So what do we need to consider when out of this entire situation? You have to consider theta. So when you sell, anytime you sell in the cover call, you have to consider theta time decay. Now we are 120 days out. So it's going to be the least amount of impact at 120 days, which is right here. Now I told you I want to close it out somewhere between about the 50% mark. So we're looking at 60 days. So right here at 60 days, which is this section right here, theta is going to start to ramp up. It's not going to be as felt if I were to let it go out until it's 30 days until expiration. That's going to depend upon what the market is doing, how my technicals are looking. Is this stock going to rise beyond my current strike price on the covered call? These are the things I have to consider. So typically when you're trading options, you don't have to, in some of the other strategies, you don't have to monitor the position as often as you would in a situation like this, because you chose a strike price to where this stock, and this is this stock could actually exceed that strike price. You want to keep an eye on this, and you want to keep an ear in the news and see what's going on with that particular stock. You want to update, make sure you set alerts on this particular stock for changes in price and catalysts that may affect the stock. So why are we really, how are we hedging our position? Anytime you're hedging your position in the market, that means that you're putting on another investment to make another investment better. So look at what you've done so far. So let's go back before we close out the video. You sold a secured put and you put up $300 in collateral. Now, when doing so, you collected a premium of $30-something, right? So essentially, what you did was you hedged that $300 immediately once you put it up, because you lowered the cost basis on that stock. And what would have happened was one or two things would have happened. If you did not get a sign, then you would have gotten your $300 back. You would have gotten a free $35, and all is well. The best thing that could have happened, which happened to me, was that I was assigned, they called away the $300, but I have $35 right here. So they didn't really call away $300. I got $35 in my pocket. So my cost basis is immediately lowered. Now that I have the stock, I can go out and further hedge my position dealing with these stocks by selling a covered call against the stock and collecting more premium. Now, I'm in a win-win situation. If the stock goes up, I win. If the stock starts to go down, I win, because the stock would have to drop below our cost basis. What is our cost basis, people? It is $1.77 per share. So with it being $1.77 per share, we have a lot of time to notice the market that this thing is in a bad downtrend, and we just want to get something happen. A major catalyst occurred, which made the market change directions from bullish to bearish, and it's going to stay in that downtrend. We can sell, and we didn't lose anything. Unlike the person who purchased the shares at $345, now they are completely dependent upon what the market does. If the market drops to $3, like right now, it's at $2.55. They are already in the hole by almost $100 or a little over $100. So that's not good. But when you sell options, you actually have options. All right, that's my time for the video. Please subscribe to the channel. Thank you for watching. And I'm